Good morning or good day to you all wherever you are, and thank you for joining me on another installment of my monthly strategy update. This month's presentation is entitled Becoming a Little More Aggressive. The market has had to contend with several significant headwinds this year. The primary fear entering this year was navigating a potential recession, and then we had the banking system turmoil in March and the looming debt ceiling negotiations in May. Accordingly, with interest rates on bonds at attractive yields, it seemed quite prudent with this backdrop to remain conservatively positioned, and so we have been. In fact, heading into May, we became even more conservative on an asset allocation basis and took money out of equities to protect against the politics of DC. And so, with the debt ceiling crisis and the banking turmoil in the rearview mirror, we're turning our attention back to the economy and also adding back to equity allocations, albeit modestly. Again, our stance of being patient remains, but we are getting marginally more optimistic about the direction of the market and the economy. One of the unique features of which I've highlighted for several months now is the extraordinary level of dispersion in the market. At the index level, you can see that year to date, the NASDAQ has gained over 24% this year. This is through just a couple of days ago. Versus the more cyclical Dow Industrials that are flat. The S&P is up around 10%. Recall, the NASDAQ was down 33% last year, while the Dow was down only 7%, a huge role reversal this year. Getting this pivot right has been a huge challenge for investors. Now, it bears reminding that the definition of a bull market is often defined as when an index rises 20% above its most recent low. By this definition, the NASDAQ is back in bull market territory after last month's big move, and the S&P is just about into a bull market itself. Now, plenty of things could happen to cause a pullback, and you'll see why on the next slide. But as tactical managers, there is a risk to the upside that the economy does not fall into recession and that the market will look through any current weakness. So we need to get a little more aggressive. I've shown this table for a few months now to show just how much of the S&P's return is coming from just 6 large technology stocks. Year to date, this group that includes NVIDIA, Meta, Apple, Microsoft, Google, and Amazon are up a combined 49%. They were up a whopping 11% in May alone, as artificial intelligence caught fire in the minds of investors thanks to NVIDIA's earnings announcement. Meanwhile, the other 494 stocks in the S&P are up only 3% this year. And we're actually down 3% in May, reflecting concerns about the economy and the debt ceiling negotiations. And if you look further, these stocks are actually trading at a fairly reasonable price to earnings multiple of 16.5% or 16.5 times, whereas the top 6 tech stocks are now trading at an elevated 28 times PE. So the point here is that AI, which has been a key theme in our portfolios for years, has created a euphoria for a handful of stocks. Meanwhile, there is significant value to be found throughout the rest of the market. So as we think about capitalizing on non-AI opportunities, we need to turn back to the economy to find the right places to invest. Manufacturing continued to shrink through May, as you can see on the graph on the left. And there are many company-level data points to suggest that there is a full-fledged recession ongoing in certain parts of the economy. For instance, just yesterday morning, Old Dominion Freight Lines, one of the largest trucking companies in the country, announced that the number of May tons per day shipped fell over 14% from a year ago. Demand for goods has been in recessionary territory for months. Services, which account for almost 80% of US GDP, continue to show some growth. The graph on the right shows services PMI surveys from both S&P Global and the Institute of Supply Management. With both above 50, that indicates that services are growing. Note the difference between the two surveys. The S&P Global survey comes in at 55 versus the ISM's at 50, indicating higher growth. Why is this? The S&P survey does not include retail and wholesale trade, government, construction, agriculture, mining, and utilities, which by deduction, we can conclude are areas having more difficulty. But for now, there is a big chunk of the economy that is growing nicely. Think travel, education, healthcare, etc. The underlying strength of the service economy is a big reason why the market has had to push out expectations for when a full-fledged recession hits. The Conference Board estimates, you can see here, have been consistently too low, and they still believe that GDP will shrink 0.6% this quarter and for the next 2 quarters. Meanwhile, the Atlanta Fed's nowcast GDP measure currently sees this quarter at around 2% growth. That's certainly not recessionary. Economic forecasters have likely misjudged the continued strength of the labor market, which is the key driver of consumer spending and, frankly, the economy. Last week, non-farm payrolls yet again surprised to the upside, posting 339,000 jobs created during the month of May. In fact, we have seen an acceleration in job creation during the last 3 months. Further to the strength of the labor market, continuing unemployment claims, the chart on the right, have seemingly stabilized at levels similar to those in 2019. These data points together and others suggest that a full-fledged recession is not right around the corner, barring any external shock, of course, but it could mean higher interest rates. Fed Chair Powell has continually expressed that the labor market needs to soften to stop raising interest rates. We disagree to some extent with this position, but nevertheless, it is important to incorporate these data points along with inflation data points to assess the Fed's next steps. What informs our view that we are very close to the end of the interest rate tightening cycle is how rapidly inflation is falling economy-wide. As we have shown in previous presentations, we prefer the real-time measurements of inflation by a company called Trueflation, which is free, you can find it on the internet, rather than rely on the archaic data collection methods of core PCE and CPI. As you can see from the graph, Trueflation's algorithm estimates that inflation today is running at just about 2.9%, which is well below CPI, which is recording at 4.9%. So in other words, we believe that inflation has declined much further already. And this is great news, not just for the trajectory of interest rates, but also for the economy and consumer spending. Rather than spend all of your disposable income on things you have to have, like gas in your car, consumers are able to spend more on discretionary items now. Not surprisingly, with a still strong labor market and falling inflation, consumer spending continues to remain strong. And you can really see how declining inflation is even helping consumers save more of their income in the chart on the right. Behavioral finance is a really important part of investing. Market psychology has a tendency to overshoot, being too optimistic at times or too pessimistic at times. Lately, all one hears is pessimism about the economy. Just a month ago, recession this year was the consensus view. And yet, if you look at the Citi Economic Surprise Index, which measures where economic data has come out versus expectations, anything above that red line on the graph means that the reported data is beating expectations. And as you can see from the chart, that since September of last year, the data is coming in generally better than feared. So this market is digesting that we have a better than expected economy, and as thus over the last month, increased interest rate expectations further out the Fed funds futures curve, as you can see from the graph below. At present, the market expects the Fed to pause at the June meeting and then raise 25 basis points at the July meeting, and then keep rates roughly flat throughout the rest of the year. This is now much more in line with Powell's recent comments and also reflective of an economy not in recession. So to turn back to return dispersion for a moment, as you can see from the chart, the top 6 tech stocks are represented by the black line. After a very difficult 2022, they bottomed out in November of last year. I circled in red a few of the places where we added tech stocks to our portfolios, and I'll touch on that a bit more in a minute. But the other observation is that the rest of the S&P, noted by the blue line, is basically flat over the last 12 months. Okay, so I wanted on this slide to show all the dates where we added tech, growth, or artificial intelligence exposure to our portfolios since tech bottomed out last November. I won't go through this slide in detail, but I'm happy to come back to it. Just know that we have been on this trend from literally the bottom with the purchase of QTech early in November of last year. So to continue with our thoughts on how to position portfolios, I wanted to return to the three key outstanding questions that I presented last month. The debt ceiling was resolved. The alternative was unimaginable, but that's in the rearview mirror now. On the question of will the banking turmoil lead to a tighter lending environment, it hasn't yet. We watched the weekly H.8 data from the Fed on loan growth, as well as listened to bank executives, and so far so good, but that will remain a watchlist item. On the final question of whether the Fed has raised interest rates too far and will tip the broader economy into recession, it's too soon to say, but thus far, all indications are reading okay. So taking all of this into account, we have added back to equities and have modestly tweaked up the beta of our equities in light of moving past the debt ceiling and the better economic data. So practically, we are modestly increasing our equity allocation across all strategies. We added some additional tech exposure, and just this week, we've added a beaten up energy stock that had been left for dead in our view. And we may go further. If the S&P 500 enters a bull market, we will need to add more stocks. And we have found many that offer significant long-term value. The banking turmoil and concerns over the economy have created really attractive entry points for many cyclical stocks. So let me stop there and open it up for questions. But the key point I want to leave you with is that we are incrementally and carefully taking more risk. Tom, let's take some questions.
Great. Yeah, thanks, Jim. Yep, and there are some here. First one is, what do you think about tech stocks, particularly AI micro class stocks?
So there are a lot of stocks right now masquerading as AI when in fact they are merely just automation. And so that's the first thing I'll tell you is you need to be very careful about which stocks you think are AI versus automation. Not that automation doesn't have a role to play, but I don't think that the promise of AI is nearly, the promise of automation is nearly as high as the promise of AI. Certainly, more broadly speaking, I think that AI stocks have had a very, very big rip recently, and obviously NVIDIA can be the sort of star of that show. It's very possible that you'll see, kind of a short-term pullback, but as far as we're concerned, AI has been a massive theme in our portfolios for years, and I think it will continue to be. The opportunity set is maybe as large as the internet itself in terms of the productivity that this creates. I mean, even internally, we have taken to engaging AI consultants recently to create further intelligence in our operations. And I can tell you that what we're finding is an enormous productivity enhancement possibility. And I'm sure that there are other businesses, large and small, that are experiencing the same thing. So generally speaking, very long-term bullish on AI and tech stocks. Short-term, I think given the big move they've had over the last month or two, it would not be out of the ordinary for them to pull back in the short run.
Great. Another question here, Jim. Student loan payments resume August 30th of 23. Do you expect this to negatively impact projections of consumer spending, savings, and economic outlook?
Well, I mean, there's actually a fairly small percentage of people that will really have a difficulty handling these student loan payments. And yeah, so maybe there are going to be some specific companies that will see a drag, particularly those catering to millennials. But this is not a big enough issue in my view to drag down a lot of the market. This is kind of an issue that you can just dodge.
Got it. Do you think small caps will begin to rally?
Well, great question. I I think in the near term, with the lifting of the debt ceiling, there is going to be more generally some risk taking involved. You could see additional risk taking if we sort of officially establish the S&P being in the bull market. And when that happens, the fear of missing out starts to kick in. And from our perspective, small caps have there's been a lot of underperformance amongst various small caps. We don't think about the world in terms of small cap, large cap, medium cap. That's something that we think that is kind of old and antiquated. But I do think that if you're looking for outperformance and the market starts to get into this more risk-on bullish mode, they're certainly going to outperform. And we certainly see a lot of value, not just in small caps, but in a lot of cyclical stocks. Some of the valuations have gotten to be, really out of this world, low. And so I think it's right now, I look at it as you want a barbell, what you're adding to your portfolio. You need to obviously add some AI and tech, and you also need to be adding where there's tremendous value that where a lot of stocks have been left for dead.
Great. There's another one in here. Can you expound on the reasons you disagree with the Fed that labor market needs to soften to stop rate hikes?
Yeah, so I mean, the Fed's been basically wrong at every turn. They first said that inflation was transitory. Clearly it wasn't. We pointed that out at the time. And what they've failed to really understand is the dynamic that's going on in the labor force. When we had an economy that radically got flipped on its head from 60% services, 40% goods spending, and it got flipped the other way and created this enormous surge. Essentially, bartenders lost their jobs and became Amazon drivers. And that's a simple example I give. Now with goods basically more in a recession, you're seeing the shift back to services. But the shift has been lumpy, right? And so it created initially that on top of the fiscal stimulus plan that allowed people to stay on the sidelines longer and not get a job, created an initial surge in wages. We're starting to see that come down. And that's really the specific point that the Fed is making, is that in order to ensure that we don't have elevated inflation for quite a long time, you have to get the wage inflation down. And I think you were naturally seeing that as layoffs are having in the goods part of the world, but they're being picked up in the services. And as that supply shifts, the wages that those service workers can demand are lower. So you're seeing sort of this natural correction happening in the market. In addition to that, though, you can see that we're getting basically disinflation, if not deflation, in much of the goods part of the market. We've had deflation throughout commodities as well, particularly energy, right? Over the last year, we're seeing disinflation, certainly maybe deflation in housing and that sort of thing. So there's a lot of places you can point to the market where prices are actually going down, not up. And so the emphasis that the Fed at least puts on a softening labor market, we think is less important than perhaps they do. So maybe saying completely disagree is too harsh a way of putting it, but we certainly think that they're putting a stronger sense of emphasis than we are on that particular part of the inflation equation.
Great, thanks. Do you have time for one more?
Yeah.
So can you dig in a little bit about the difference between the CPI and the trueflation number, and why we believe that inflation is closer to the trueflation number?
Yeah. Well, first of all, look at the way the surveys are actually constructed. Trueflation is using technology to monitor 10 million real-time data points across a whole variety of goods and services in the economy. And that is happening on a daily basis. And contrast that with, and many of that too is electronic in terms of whether it's scraping prices off of websites or what have you. Contrast that with the manual process that the government uses of sending thousands of people into the field with clipboards and surveying prices and interviewing store owners once a month. And then obviously we've talked about in the past how the way that CPI calculates housing has like a 12-month lag on it. So most people have completely ignored that part of CPI anyway. So, in our view is it's much better to use real-time data that is digitally collected than it is to necessarily rely on the clunky old ways. And I would say that across virtually how we look at a lot of things in how we due diligence and monitor trends in the market. But I welcome you to check it out yourself. You can go to trueflation.com, read the methodology. Let's put it this way: we don't put 100% faith on any particular source of data, but it is a data point. We think it's just more relevant than CPI.
Great. I think that's it for the questions, unless somebody wants to add a last minute question. It looks like we're through all of them. So appreciate everybody hanging in there and staying with us through the webinar. Thank you for your partnership and support. And as a follow-up, I'll make sure that everybody on the call gets a copy of the compliant approved version of this so that they can send out to their clients. Thanks, everybody, and have a great week.
Thank you.